What is going on, traders? The Fed just turned the money printer on last week. The China deal seems to be done as of this weekend. Tech earnings grew by almost 27% when there was an expected 21% growth. And get this, Nvidia, AMD, and Broadcom haven't even reported yet. We are also entering the best month historically for the stock market, which is November. And the stats on November and December are even stronger when May, June, July, August, September, and October are green. This has only happened 4 times in history, including this time. And here are the stats for November and December every time that has happened. And when January through October are up by 15% or greater, the last 2 months of the year have always been green, with the exception of one, and the worst case scenario was negative 0.7 for November and December. So as always in this video, we'll go over the critical news for this week. We're going to briefly talk about the Fed money printer, the China deal, the fact that tech earnings have absolutely blown expectations out of the water, and how we are entering the best month historically coming up. Also, AI spending grows. What we learned from earnings wasn't that the tech companies beat earnings. We all knew they were going to beat earnings, but their AI spending gets even more out of control, which means that the bubble will likely continue getting bigger, which will mean there are potentially opportunities for us to take advantage of if we pick the sectors correctly that support this bubble getting bigger. I don't know what the word bubbler is. That sounds like a job for somebody. As always, towards the end of the video, I will be giving you my playbook game plan for the week, what stocks and trades I'm looking at. So let's get right into it. So the FOMC meeting was last week. As expected, Jerome Powell did cut the Fed funds rate by 25 basis points. Now, they did say that they were going to stop quantitative tightening in December. The markets knew the end of QT was coming, but just weren't set on when. And he confirmed that December would be the end of quantitative tightening. This is the first step in money printing. And as of this weekend, the Fed pumped about $50 billion into the banking system, the biggest injection recently since going back almost 20 years. So it was about $29.5 billion in treasuries and almost $30 billion in mortgage-backed securities. Now, the one very strange thing that Powell did in that meeting is he came out and said that a rate cut in December is far from a foregone conclusion. This is very different to what he said the previous FOMC meeting when he said that he expected the Fed to cut in October and in December. Now, we've seen Jerome Powell operate for 6 or 7 years now. I kind of know how he works. He's not going to come out and give the market all of this enthusiasm in one meeting and say October rate cut, December rate cut, stopping of QT in December. He had to dial it back a little, especially since he did announce a firm date for the stopping of quantitative tightening. So he said October rate cut, December stopping of quantitative tightening. And then he kind of kept a bullet in the chamber and said, the rate cut in December is far from a foregone conclusion, even though I think they're going to cut in December. All right, and as of now, as of the time of this recording, who knows what the next tweet will reveal, but it looks like the China deal is done. So straight from the White House's website, they highlighted the actions of each of the parties of the deal, the Chinese actions as well as the American actions. But the long and short of it is that China is going to keep buying soybeans from the US. China will suspend all of its retaliatory tariffs. And most importantly, it's going to stop its export controls of rare earths. And the United States will then lower the tariffs on Chinese imports. Basically, the effective tariff on China will be 10%. And this likely won't be revisited again for another year. Now, I'll dive more into this when I talk about my playbook for the upcoming week. But if you remember from the last video, I said that it is my perspective, it is my thinking that in this period, the US and the Trump administration are going to try to ramp up the refinement of rare earths here in the United States, and that will likely be bullish for rare earth stocks. And here is Scott Bessent today confirming exactly that.
They think that the Chinese weren't going to roll out these rare earth restrictions. They've been putting this plan together for 25, 30 years, and the U.S. has been asleep at the switch. And now this administration, we're going to go at warp speed over the next 1-2 years, and we're going to get out from under this sword that the Chinese have over us, and they have it over the whole world. And this time, we have rallied the allies, and so it is going to be all the Western democracies, the Asian democracies, and India are also going to join us in this in trying to form our own supply chains. We don't want to decouple from China, but we need to de-risk.
So stocks like the Quad U's, which is energy fuels, USA Rare Earth, there might be an opportunity in stocks like this. So I'll go over it more when we talk about the playbook. All right, tech earnings in Q3 up 26.5% versus an expected 21%. And crazy enough that these companies, a lot of big tech companies, NVIDIA, AMD, Broadcom, and others, have not even yet reported. So you can see here the tech sector, the S&P 500 earnings growth, 26.5%, and 21% was the expected Q3 growth. And it's not just tech, by the way. If you look at all of the sectors, utilities, financials, materials, the S&P 500 itself, consumer discretionary, real estate, industrials lagging behind, healthcare better than expected, consumer staples better than expected, energy better than expected. So really industrials and communication services are lagging, but the rest of the sectors, and most importantly tech, beating much better than expected. And speaking of earnings, this week we have Uber, AMD, Supermicro, Palantir, Shopify, Spotify, Robinhood, ARM, The Trade Desk, Qualcomm, and many others. So although not the Mag 7 earnings, there's still some really nice companies left to report. And depending on their earnings history, there might be some asymmetrical plays here, whether these companies beat or meet the expected move. Obviously, in the Discord, I will have all of that information for you guys on which companies beat or meet the expected move. That way you can know whether you want to trade a strangle, for instance, in both directions, or an iron condor if the company's not expected to move that much after earnings. And next up, as I said, the best month historically is coming up. November through April in general is the best month historically in the stock market ever. It doesn't mean that every one of these months is green, but if you take the overall average, 77% of the time, November through April is up. And when it is up by an average of 7% in the 6 months. But like I said, when May, June, July, August, September, October are green, November and December have been green 100% of the time. And when we're up 15% through October, the last 2 months of the year is almost 100% green with the exception of 1 year. And that was basically flat. It just goes to show that higher prices beget higher prices, right? That's the definition of momentum. And lastly, we'll talk about AI spending very briefly as the bubbler gets bigger, and then we'll get into the playbook and the stocks and trades that I'm looking at this week. Now, as I said in my last video before the Mag 7 reported, I don't expect this Q3 earnings here to be the earnings season where these companies report a cutback in spending. I think that as long as these companies, Google, Microsoft, Meta, Amazon, as long as they have healthy cash flows and they are the biggest companies in the world, they are going to continue spending. This is an AI arms race. They are not going to be, not one of these companies wants to be the first one to fall behind. They would rather overspend while they have the cash than try to figure out where the cash is going to come from if we are in a recession or in a downturn. Right now, we are in a bubble and these companies are generating the most cash that they ever have. And I just showed you that they beat their earnings expectations really significantly. So while they have the cash, they are going to spend as much as possible building up the infrastructure for the AI future. Like I said, they want to build the infrastructure first, and then they're going to think about the application layer later. But the most expensive and intensive part of the AI build out is the AI infrastructure and hardware. And that is what these companies are doing. And they are spending even more than the market expected. Now, this is part of the reason that Meta's stock price fell, because it is spending higher and it is generating less cash than, say, an Amazon or a Microsoft, which their cloud divisions are growing astronomically. And so even if they are spending more than the market anticipated, they're also making more than the market anticipated. Meta did have that $15 billion tax hit. We'll talk about Meta because there is a juicy opportunity on this stock, on this overreaction drop here. Now, one concerning thing about the AI spend is the fact that companies are now, even big companies are now taking record amounts of debt for the AI build out. So while companies like Google, Microsoft, and Amazon have not yet announced a debt offering, Companies like Oracle have announced the biggest debt offering in history for that company, $38 billion. And Meta, their jumbo debt offering was for $25 billion, but they drew in a record $125 billion of orders as bond investors, corporate bond investors, are clamoring to hope to get a piece of the Meta debt offering. See, a company can raise money in a couple of ways. One, they can issue more shares. But companies are not going to issue more shares if they don't have to, because that means that they're going to dilute the shares, thereby declining the stock price for the rest of the shareholders. It is a bad look. That's why company stock price goes up when they do share buybacks. So if they issue more shares, the company stock price is going to drop due to that dilution. Another thing is if a company is highly rated and has, a triple A plus whatever bond rating as a company like Meta or Microsoft would, they can issue debt. They don't have to issue shares. And corporate bond investors who are looking for a safer yield, but a higher yield than, say, a treasury, they will buy into those debt offerings from these mega cap companies. Now, this just shows how rabid the spending on AI is, where companies that haven't traditionally taken this much debt historically, they are now just doing debt deals left and right, and thereby increasing the circular deals that we talked about with regards to AI. So in and of itself, each of these deals is not that big of an issue. But if all of these companies start issuing debt deals to spend and spend and spend, obviously you're inflating the bubble. And at some point, the market is going to realize that you spent trillions of dollars and all we have are chatbots, and that's it. And that's when the bubble pops, and then it will start to build back up slowly as we figure out how to implement AI in our society beyond chatbots. All right, let's talk about the playbook and game plan for the week. What stocks and trades am I looking at? All right, so looking at the markets here, you have the S&P 500 on the left, NASDAQ on the right. This weekly gap was from Friday, October 24th to Monday, October 27th. This was the first, I believe, if I remember correctly, the announcement of the potential easing of the trade deals before the trade deal was actually finalized this weekend. But you can see that the S&P 500 retested that gap, NASDAQ didn't. Now, this could be seen as bullish divergence. But in my opinion, if we are going to have a strong November and December, we need to see a little bit more of a pullback. So I would not be surprised to see the market pulling back earlier in the week, potentially, especially because this week we are getting some jobs data. We're getting the ADP non-farm employment change on Wednesday. We are also getting PMI. Some of these other jobs numbers like JOLTS job openings, as well as the non-farm employment change, the unemployment rate, these are all tentative. The government is still shut down. So if the government opens up, then we will get these numbers. But the ADP one, because ADP is a private agency, this is going to be released and will be the first set of job numbers that we've had in a very long time. So I wonder if that news can give us a little bit of a pullback here before continuing later in November and December. I would not be surprised if the first part of November is a bit shaky, sideways, maybe a little bit of a pullback. Well, first and foremost, I'm looking at Meta as an investment, not only a trade. Because Meta, obviously there was an overreaction drop after earnings. If you look, it looks like they missed earnings, but they had a $15 billion one-time tax hit. And if you remove that, Meta would have actually beat earnings by quite a big margin. So in my opinion, that's not that big of a deal. But you couple that with their increase in spending and their revenues not going up by the same rate, there was a little cause for concern here. However, as I said, I expected Amazon to get to all-time highs before end of year. Obviously, Google, Microsoft, Tesla, etc. And now it looks like the market gave us an opportunity on Meta because I do think that it will be back at $800. It is a cash generating machine. And I think that there is an opportunity to take advantage of this overreaction. Meta is still in a very strong position. You see their Q3 2025 revenues up 26% year over year. Their daily active users, which is half the world, their ARPU, which is average revenue per user, are rising due to AI targeting. And here's the juicy part. Look at their cash flows. cash flows of 107.5 billion trailing 12 months. Their free cash flow margin 20.7 up year over year. Their gross margins are 82%, which are basically unheard of in this day and age. And their forward PE for a tech growth company is historically low here relatively. Their earnings growth for the next 12 months is expected at almost 30%. So from an investing standpoint, I'm interested in Meta here, obviously. I do think that there is a chance it can come down to that between 600 and 630 range, but I do think dollar cost averaging in this range here between 600 and 640 is key for the long term. Amazon, in my opinion, is long gone. I don't know how many times I had to beat the drums on you guys for Amazon as well as for Google. Shout out to those of you who took advantage of that, sitting at all-time highs on both. And I just want to take a moment, shout out a couple of Traveling Trader Academy members here. Nick T had his best month ever, up 10%, almost $50,000 in the last month alone. Shout out to Regine, whose Amazon calls went over 100%. And Torres, who absolutely banked in both directions during our FOMC stream. Damn, bro, he killed it. Almost 22K on the puts, 22K on the calls, traded the manipulation perfectly. If you want to trade live with me every single morning, sign up. Link is in the description below. And let's get back to the plays. And in terms of investing, honestly, guys, I mean, there's just so much that I was telling you guys that I was jumping in for investing. All of these things are near all-time highs. Dell has made a nice run. Marvell has made a nice run. There aren't ASML, obviously, near all-time highs. There just aren't that many investments left for the long term, in my opinion. You know, you do have companies like UNH, which I told you guys I do not expect United Healthcare to run in the short term. I do not expect this to have a momentum trading like a semiconductor stock. I do think it's good value for the long term, but it's not going to run in the short to midterm, in my opinion. The higher that these valuations get stretched, it's just, in my opinion, very hard to invest for the long term at these levels. And that's why I kept trying to hammer these investments when they were actually at asymmetrical periods. So the way that I think about it in the short term, like when what I was saying in April, May, it's become riskier not to invest than it is to invest. And if you think about where stocks are at the moment, it's become riskier to invest here than to just wait it out, in my opinion. Obviously, trading is a different story. You're in and out. I'm talking about buying and holding at these peaks. Everyone has a different time frame. If you have 5 to 10 years, buying at these peaks could absolutely burn you. If you have, 20, 30 years, you might worry about it less. Now, we talked about Meta as an investment, but for a trade, I'm looking at Tesla here. Obviously, been in Tesla since the low 200s. You guys know that if you've been watching the channel for months. But from a trading perspective, there is a bull flag here on Tesla, and it is retesting all of these highs. And you can potentially take a pretty low risk long to all-time highs at around 490, which I think it will get to by November, December. And you can have a pretty tight stop at around 425-ish in case Tesla does trade back into this weakness in alignment with potential market weakness. All right, another trade that I'm potentially looking at here is Netflix. So Netflix announced a split. Now, they didn't announce a split during their earnings. They announced a split just a few days earlier, and their split is going to take place on November 17th. What we typically see is we see a run up into the split, and then once a split happens, you get a sell the news effect before the stock continues to run up. So I think that in this case, especially because we had this consolidation and we dropped to that level below the May lows, we can potentially see a little bit of a run up. I don't think Netflix is going to go sky high in the short term, but I do think that we could see a little bit of a run up into this gap before the 17th. Now, the bid ask on Netflix options is not great on all of these strikes and expirations, so we will have to tailor this. There is also a leveraged ETF, NFXL, which sounds like a sports league, but I wouldn't trade options on this. It is a cheaper quote unquote stock because it's not trading at $1,100, it's trading at $47. So instead, if the bid ask on options suck, might go with NFXL shares and just swing trade these. Now, speaking of rare earths, these aren't stocks that I typically want to be long-term invested in, really. I mean, it's not my typical sector. I'm not saying anything about it. It might be yours. You might have done more research on it and are more bullish on it than I am. However, I do think that in the midterm, as I said, I do think there will be an opportunity in rare earths. Now, this USAR, which is US Rare Earth Inc., I think that this technical pattern here where we have these highs, this resistance level, we are now testing that as support. And come next week, I'll be very curious to see how the market reacts from there. Also, let me pull up the moving averages here, the 50, 100, etc. And I want to see where this is sitting. Okay, so we're sitting right on the 50-day moving average at this support resistance level. And I bet you if I pulled up a fib, this is going to be at the golden pocket of the previous rally. Yes, we are at the gold. So from this level, I'll be very curious to see whether we get a confirmation on the low time frame, but USAR may be a nice buy here at this level around 20. Now, Energy Fuels is a pure momentum stock. And as you guys know, momentum stocks love to hold this pattern where we break out and we start retracing with low volume to the 921 EMAs, which are these two lines here. And you can see it following this pattern, and we are now sitting at the 921 EMA. And if I pull up the volume, you'll see that you want to see volume spikes on the up moves, and you want to see trailing off volume on the retracements. So as long as we stay above this 21 EMA, I think that there are short-term to mid-term longs on UUUU. There has to be an easier way to say that stock, Quad U. Now, MP looks really ugly here, I'll be honest. If you inverted this and you took a look at this pattern, this would be a pattern that you think might break out into a long. But if we switch it back to regular scale, this looks like there might be a bit more drop. Now, it does report earnings November 6th, so I'm likely not going to trade it before earnings. Now, I do want to see if it does move during earnings typically or stay put. It says the options market overestimated MP 85% of the time, meaning 85% of the time in the last 12 earnings, MP did not beat the expected move. One, that makes it a good candidate for an iron condor. Two, that's actually a good sign because that means that we can actually wait to see how it behaves during earnings before taking a long position on it. There is a support resistance level here at this high, and this is the 21-week EMA now, right? So there is impetus or reason for it to jump from here. But again, this pattern, this rounding top pattern, I do not like it. So on MP, I will likely wait for earnings to see if we can get a little bit of a drop. And then if we confirm below this level and come back up it, there might be a break and retest scenario here. Now, I can't go through every single rare earth stock, but you guys get the picture. And then obviously the AI build out stocks, which we've already made a ton of money on, IREN, CoreWeave, these are all still in playable situations here, as well as energy or power stocks like Oklo. None of these, in my opinion, are long-term investments. These are all just short to mid-term momentum trades. And going back to the indices, if we do see some sell the news from the China deal, if we do see if the government reopens and we do see a sell the news drop on the government reopening, if we get a drop due to some of the news that's being reported this week, in my opinion, those are longable drops. And we want to see the market retrace a little bit earlier in the week to take advantage of those November, December stats that I was talking about. And lastly, I'm doing a 2-day live options and futures trading accelerator. This is November 8th and 9th, which is a Saturday and Sunday. We are going to be talking about options or teaching options in the first day, which is November 8th, and then futures in the second day. This is all going to be surrounding swing trading and day trading, not investing, but it's absolutely free. You will have to register to get the link. If you are not registered, you will not get the link. So make sure you get your name on this and take your trading to the next level in 2026. Every year you promise yourself you're going to work on it and you don't. let this free event serve as your springboard. And if you want to trade live with me every single day, you want to get the specifics of what I'm trading, when I'm trading it, link is in the description below. Join me live at 9:30 a.m. Eastern every single morning. I will see you there. Leave your comment down below. Let me know what you are trading, what you are investing in right now. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.